Have you ever looked at a tax form that was, well, mathematically perfect, but from a legal standpoint, completely and totally wrong? Today we are going deep. We're going to audit a really dangerous document, a single Form 1099-R from a custodian that mashes together two very different kinds of Roth IRA distributions. And let me tell you, it is a subtle, sneaky error that creates a massive tax trap for anyone who isn't paying close attention. Okay, so let's get into it. Here's our plan of attack. We are going to forensically unbundle this whole reporting mess. We're going to expose a really surprising twist when it comes to the RMD rules, and then I'll lay out the exact step-by-step method to fix it, so you can protect your money from getting taxed down the road. So here's the case file. A taxpayer gets a Form 1099-R in the mail. The main number, the gross distribution, is just the simple sum of two withdrawals, one from their personal Roth and one from an inherited Roth. The math adds up perfectly. But from a tax law perspective, this document is telling a story that just isn't true. And it puts the taxpayer right in the crosshairs, fighting their own tax software and potentially the IRS itself. And this question right here, this is a real question from a very confused taxpayer. This is the absolute heart of the problem we're investigating. It just perfectly shows how one consolidated, seemingly correct document can cause so much confusion, trigger totally wrong tax calculations, and cook up a tax bill where one should never, ever exist. Right, so to solve this puzzle, we have to start with a bedrock principle. You have to understand this. Under the Internal Revenue Code, a Personal Roth IRA and an Inherited Roth IRA are treated as two completely different species of accounts. They're not the same, and mixing them up, well, that's the original sin that causes this entire mess. So first step, you've got your own Personal Roth IRA. This is governed by Internal Revenue Code Section 408A, and the two big ideas here are control and documentation. You decide when to take money out, and it's on you to meticulously track all of your after-tax contributions. We call this your basis, and you track it on Part 3 of Form 8606. This basis is all the money you've already paid tax on. It's what you can pull out completely tax-free. But then, on the flip side, you have the Inherited Roth IRA. This thing operates under a whole different legal playbook, mainly IRC Section 401A9 and the Secure Act. Look, this is not a permanent savings account for you. It's a temporary bucket that has to be emptied. But, and this is huge, it comes with a bulletproof exception to the 10% early withdrawal penalty, found right in IRC Section 72T2A2 for any money paid out to a beneficiary after the owner has passed away. And this table just lays the whole conflict out, plain as day. For one account, basis tracking is absolutely critical. For the other, it's pretty much irrelevant. The 10% penalty is a major worry for your personal Roth, but it's a total non-issue for the inherited one. The distribution codes are completely different. They're mutually exclusive. These accounts are running on opposing legal directives, which is exactly why smashing them together on one form is such a big problem. Okay, now let's zoom in on the most important piece of evidence on that 1099-R, the little code in box 7. This single character, you can think of it as the genetic code of the withdrawal. It's what tells the IRS computers the real legal story behind why you took that money out. Let's start with code 4. Its main job is to send a very clear signal to the IRS. It says, hey, this distribution is happening because the account owner died. And because of that, as mandated by IRC Section 72T, the 10% early withdrawal penalty does not apply. It doesn't matter how old the beneficiary is. Code 4 is basically a penalty shield. Now look at Code J. This sends the complete opposite signal. This is a big red flag to the IRS. It screams, hey, this might be a non-qualified distribution from a personal Roth by an owner who is under 59 and a half. That code immediately triggers automated checks for both income tax on the earnings and that 10% penalty. So here is the trap. The custodian, by combining these two different withdrawals, is forced into a double bind. It's a heads-you-lose, tails-you-lose situation. If they use Code J, the IRS automated underreporter system is going to try to slap a 10% penalty on the inherited money, which is legally penalty-free. But if they use Code 4, your tax software might see death distribution and block you from applying your own personal basis from Form 8606 to your personal withdrawal. That means your own money gets taxed. Either code they pick sends a corrupted signal.
Okay, so now we get to that taxpayer-specific question about reporting their required minimum distribution, their RMD. And this leads us to a really unexpected and, frankly, a very relieving revelation about the rules for inherited Roth IRAs.
So first, a little background. For most people who are not a spouse and who inherited an IRA after December 31st, 2019, the Secure Act created this thing called the 10-year rule, and it's a hard deadline. The entire account has to be completely empty by the end of the 10th year after the original owner passed away. And this is the question that causes so much stress. We all know about the 10-year deadline. But for an inherited Roth IRA, are you also forced to take out a certain amount of money every single year in years 1 through 9? And here's the twist. The surprising answer is no. According to IRS regulations, because a Roth IRA owner has no RMDs during their own lifetime, the law basically pretends they died before their required beginning date. Now, this is a really critical legal distinction. It means that annual RMD rule for years 1 through 9, it just doesn't apply here. The only requirement is to empty the account by that 10-year deadline. So that RMD our taxpayer took, it was just a voluntary withdrawal.
All right, we've diagnosed the problem. We understand the specific rules. Now it's time for the fix. Here is the precise, step-by-step forensic method you can use to correct the custodian's error right inside your tax software.
So here's what you do. You're going to completely ignore that single 1099-R you received. Instead, you're going to create 2 separate entries in your software. Entry number 1 is for the inherited amount. You'll use code 4, and you'll check the inherited IRA box. Then you'll create entry number 2. You'll use the same payer ID, but this time you'll enter your personal withdrawal amount. You'll use the correct code for you, maybe a Q or a J, and you'll make absolutely sure the inherited box is not checked. This split entry method rebuilds the legal reality of what actually happened. So, we've fixed the immediate fire for this year's tax return. Great. But let's talk about the critical long-term reason why this is so important. What you're really doing here is securing the scene to protect your after-tax basis on Form 8606 for years to come. Just think of Form 8606, specifically Part 3, as the IRS's official scorecard for your personal Roth IRA. It's the one document that proves exactly how much of your own, already taxed money you've put into that account over the years. This basis is everything. It's what lets your contributions come back out to you completely tax-free. So let's use an example. Let's say you took out $5,000 from the inherited Roth. Now remember, this money is already tax-sheltered. It's considered a qualified distribution because the original owner passed away, assuming they met the 5-year rule. Now, let's say that in your personal Roth IRA, you've built up a basis of $20,000 over the years. This is your money that you've carefully tracked on Form 8606. From a tax perspective, it is the most valuable asset in that account. And this slide right here shows the incredible danger if you report both distributions together on a single entry. Your tax software will get fooled. It will incorrectly spend $5,000 of your $20,000 personal basis to cover the withdrawal. But wait. The inherited money didn't need covering. It was already tax-free. You've just permanently wiped out $5,000 of your own basis, creating a future tax bill for yourself out of thin air. And that is why this is so critical. By separating the entries, you secure your financial scene. That little inherited IRA checkbox on the first entry tells the software to keep that transaction completely away from your Form 8606. This preserves every single dollar of your personal basis for when you actually need it, for your own withdrawals. It makes sure your money stays correctly documented and tax-free forever. You know, in the end, your Form 1099-R isn't just a summary of numbers. It is a legal story that you submit to the IRS. And while the numbers might add up, the story they tell could be a very expensive piece of fiction. It is absolutely your job to be the final auditor, to make sure that the story your tax return tells isn't just mathematically convenient, but is legally true.